Chip, we've been in a period of prolonged slow growth for a period of time now. This is globally as well as in the U.S., and it isn't clear when that's going to change. So in an era of slow growth and with pressure on financial leverage too, what can a PE investor do to find acceptable returns?
It's a great question. I think we've been waiting a long time for this era to come to an end. Sort of high multiples, lower finance multiples, and then strong economic growth, and it clearly doesn't seem to be happening. So I think for a private equity fund, you really have to pick your bets. You sort of have to invest heavily, in our view at least, in a few specific tools and lean in really hard in deals that can use those tools. Because if you're investing at today's pricing and buying companies with their existing growth trajectory, and you're not prepared to change that meaningfully, you're not going to get the returns you want.
Okay. What market segments or industries do you think offer the best opportunities in the kind of market we're in now?
Again, we're a lower middle market fund, and the tools we've invested most heavily in are an office in Shanghai to help our companies with Asian strategies, and then data and digital marketing, so a lot of abilities to help the companies better collect, analyze, and act on data. So if you think about those two tools and where they line up best, we've been pretty focused on value-added distribution as a segment. It's about half of the deals we've done in the last 3 years or so. And we really like it because there's a long supply chain, lots of ways we can help a supply chain, and also lots of transactions, lots of customers, lots of SKUs, lots of data. So we can really help change the needle by helping those companies better collect and act on their data.
You've said that the smaller part of the middle market offers the best opportunities at this point. Why is that? And there are lots of lower middle market firms in that segment, family offices, investing directly, et cetera. Isn't that now as competitive as any other segment?
It's plenty competitive. I'm from Cleveland. We're used to people from New York or bigger cities moving there and assuming we're all sort of yokels and they'll be king of the mountain for moving there. And I think the middle market's a bit like that. There's been larger funds that have come down into the middle market thinking it's less competitive than it really is. The few things that the middle market does have, though, that I think are really advantageous, first is there still are entrepreneurs who have founded their business. They're looking for the first outside institutional capital. And that partnership and taking care of their people, taking care of their brand really does matter. And I'm not pretending that that's the bulk of the lower middle market, but it does exist. And if you have the right tool set, you can play to that and I think win some situations where money isn't everything. And then the second part of the market that's attractive is there are still companies that are good at 3 things, not so good at 2 other things. So again, it's a really good place to use the tools you have because not everything has been picked over already in terms of value add opportunities.
Blue Point has 4 offices. That's a lot for a firm your size. Given in an era where things are investing globally, if not just nationally, and investment banks represent a lot of sellers, what does being local mean? Does it matter anymore?
It's a really good question. I think it matters in some very specific situations. So about half of the deals we do are within a 2-hour drive of either Charlotte, Cleveland, or Seattle, which are our 3 U.S. offices. And that allows us in many cases to buy businesses that we've actually known for a long time, been able to watch how they perform in good and bad times. Doesn't mean we're going to get that business on a proprietary basis without another private equity fund or buyer being present. But we tend to know the businesses well when we invest. And then we can invest in businesses that maybe need a little bit more work than others because we can be at them weekly. If it's 45 minutes in my office in Cleveland, I can be out there as much as I need to. So we can sometimes get involved in situations that funds who are at a greater distance might decide are just too much work.
You all have been doing middle market PE since the late 90s. What changes have you seen since then?
The color of my hair is a big one. But there have been a lot of changes. In the early parts of my career, you literally could put in 15, 20% equity up front. A lot of that you would get back as a management fee. Very little risk. That period obviously passed. Period of cost cutting, we can get a lot of benefit out of cost cutting. That sort of passed as well. And I think what we're left with now, and it probably is a good thing for the economy overall, is you can't make a return without, like I said, changing the trajectory of the business you're buying in really meaningful ways. So I think it's made the private equity industry as a whole a lot better as an industry, and I think a lot better for the economy, to be honest.
Okay. Chip, thanks a lot.